Great. Thanks so much. Thanks so much, Lars and the organizers. So this is. So can you please, before I start, fill this little survey? So the URLs there should also be in the chat window. It will take you to two minutes at most, and that will be very well helpful. And at the end, we'll debrief about the meaning of that. So you see the URL. Can you somehow enter it and answer? We won't have quite the origin of financial fluctuations, but we have some. I think we'll make some progress on that. So the key question is, why is financial markets so volatile? And we'll talk mostly about stocks, but almost all the facts that hold for stocks, they also holds for bonds and for exchange rates. So, but stocks are a good test case. And so there are modern asset pricing theories with time varying risk aversion, macroeconomic risk, changing beliefs. And they have a common feature, which is, and something for behavioral models, by the way, the markets are very elastic in those models. So if I buy 1% of a market, the market maybe goes up a little bit, but by very, very little, really, okay? Maybe less than 0.1%, I'll be very precise, okay? And we'll show, and then now that's where you should stop answering the survey soon, that we propose an alternative view that markets are actually quite inelastic, okay? And that small shocks to capital flows are greatly amplified in terms of their impact on the price. And it's useful to have a name maybe for that, and we call that the inelastic markets hypothesis. So it's the idea that flows have a big price impact, and more technically, it will be an elasticity well below one. I explain what elasticity means. It's the elasticity of demand respect to the price of equities. And so that raises two questions. Are there reasons to believe that or to entertain that even a priori? And then why would you care? So there are at least four motivating pieces of evidence for why you might think markets would be quite inelastic. So first, many funds, think a mutual fund, they're very constrained by mandate. So maybe typical mutual fund, you have to be 100% in equities, okay? So then if somebody, you can't hold any bonds this way. And I'll imagine, by the way, throughout the talk that you have a big aggregate equity market, and I will not make any distinction between high beta, low beta stocks. I will just say it's whole equity. Imagine everybody has a beta of 1, okay? And otherwise, that's a separate issue. And so if you're 100% equity fund, you cannot accept bonds instead of equities. So you provide zero elasticity to the market. If somebody wants to buy some stocks against selling bonds, the 100% equity funds can't do that. And even the 70% equity funds, it's very constrained because it needs to be exactly at 70% equities. So it can't do that much. Now you might say, so that means markets will be very constrained, so maybe very inelastic in a way to make precise. So what about some segment of the market that would be very elastic? And you can think, what about the hedge funds? Well, hedge funds, first they're small, they're about 5% of the market, and they tend to actually reduce their quantity of equities in bad times. So that would providing a low or maybe even negative elasticity. Another piece of evidence is that the flows across investor sectors are very small. So the turnover of shares are very high, 100% a year, but the actual flows, meaning exchanges of stock versus bonds between different investor sectors, things, households, hedge funds, pension funds, etc., are actually very small, maybe 0.5% per quarter. I'll show precise numbers. And so if you want to move, say, $1 billion worth of equities, it would be 0.3% of the top of a quarterly of the market. So it's a huge fraction of actually quarterly flows. So by that metric, also flows, markets have fairly low, fairly little exchange of risk or fairly low net transactions between equities. And then there's a more literature-driven argument, which is there's this literature on inclusion in the stock index. So we know that if a stock is, say, ejected, removed from the index, its price goes down, presumably in part because there's less demand for it. If you look at the estimates in this literature, it's an elasticity of 1, price elasticity of 1. And so in most models, the macro elasticity should be less than the micro elasticity. So maybe elasticity is less than 1 would be plausible. Okay, so now if this inelastic markets hypothesis is true, why do we care? So first, flows will be very impactful. And so, by the way, everything in the empirical side of this paper is still somewhat preliminary. But we estimate now that at least 30% of stock market fluctuations are driven by flows. And part of the charm, as you see it, is that you can replace a lot of the dark matter of asset pricing, prices which should move in traditional model because of things that are latent factors that are very hard to measure. We can replace that by very tangible flows, and you can see who moves in crisis and who moves in good times, and that will inform both empirical research and theoretical research to see, what's going on in investors' minds, investors' actions. And also several questions that are completely irrelevant or just uninteresting in normal models suddenly become interesting. So here governments could do quantitative easings for equity that will have a big impact, or on firms as they do buybacks, or insurances that will also have a big impact. And other more traditional features such as beliefs, preference shocks, they will matter, but you will see them through flows. So you can see whose preferences of belief shocks matter in which part of the market, and that's also inform things. Okay, so how macroelastic is the stock market? So we thought hard about the methodology with Ralph, and so we developed in a separate paper actually something we call granular instrumental variables, or granular IV. It was developed for this project, but we developed it in a separate paper. And so the spirit of it is going to use idiosyncratic shocks to different investors or different sectors. We'll as primitive instruments to the system, and we'll say if somebody in the system has a big idiosyncratic shock, how does that affect the price, and how does that affect the quantities of the other players in the system? And that's, in spirit, how we're going to be able to estimate the price impact of flows and the elasticity of the various segments of the market. I'll be very precise, the methodology. And so what do we find? We find that if you buy maybe 1% of a market, it increases the market value. So first, in a traditional model, essentially the market should move by 0%, at least slightly more, but essentially 0%, okay? However, in the real world, the market seems to increase by maybe 5 to 12%, or maybe 5 to 15%. Those are again preliminary estimates because we're refining even the algorithm. But in the theory part, I said 10%, just to use a simple number and have simple illustrative examples, but it's something between 5 and 12 probably. Another way to say the exact same thing is that if I buy $1 worth of shares, so I sell $1 worth of bonds and buy $1 worth of shares, then I make the market go up by a very big amount, by $10, okay? And by the way, this effect is essentially permanent in the sense, at least at the 1-year horizon, we see no mean reversion. It could be that at the 7-year horizon, there's mean reversion, the half-life of a business cycle kind of. But at least at the 1-year horizon, it's quite permanent. And so part of what we do in this paper is estimating this macroelasticity of a market. And there are big literatures estimating, risk aversion or intertemporal elasticity of substitution. And we're still trying to estimate those parameters, okay? In part, they're not very well defined because the models are wrong. And so here we do a first step at estimating this parameter. We think it's very, very important, maybe as important as those other parameters, the macroelasticity of a market. Okay, so what we do in this paper, so we developed a theoretical framework that gives rise to these inelastic markets. So I'll spend most of the talk on just using a very, very simple model, okay, taking like exogenous interest rate, exogenous average risk premium, but thinking very much about what the equilibrium of the market when you have flows. And then later in the paper, time permitting here, there's also a general equilibrium model where we endogenize interest rate, average equity premium, consumption clears, and how you do production-based asset pricing and all that. But that's more like an embellishment than the intellectual center. And now we develop also a conceptual framework that guides the empirical analysis. That's because, somebody might say, well, for every buyer, there's a seller. So how do you even measure, what moves first? And so we'll have precise answers and for that, and motivated by theory. And we'll provide these estimates of macro elasticity, and we'll see how it kind of explain in some sense stochastic volatility and maybe in part why markets move. Literature review. So there's a big literature. So the focus here, it's all on the macro elasticity, meaning I buy $1 worth of shares, selling $1 worth of bonds. There's a huge literature, really interesting, on the micro elasticity, which is if I buy $1 worth of Apple and sell $1 worth of Amazon, what happens to the relative price of Apple versus Amazon? But if this is all the micro pricing, different stocks within the stock market, not at all about the aggregate impact. So about the impact of buying one stock versus bonds. It's all about you buy a little more of that stock, a little less of that of a stock. Except for literature pioneered by Warther, but they just look at mutual funds. There's not a ton of identification in this literature, and here we bring identification, and we build in spirit, at least in some more precise thing, on the literature started by Ralph and Moto with a demand systems, where we'll have very, very simple demand systems because we think about the aggregate market, whereas this other literature is more cross-sectional. Anyway, and there are other theories of supply and demand pressure that's been mostly done for the bond market, QE for bonds, and here it will be QE for stocks if you want. And there are models with flows in markets, but they tend to be very qualitative, and here we want to be also very quantitative. Okay, so outline. So I'm going to start with some simple suggestive facts, so we're on the same page. Then I'll talk about a very simple model that allows to cleanly to think about, price impact and impact of flows and equilibration in the whole market. And then the meat, empirical meat, will be this empirical investigation. So what's this macro elasticity? And once we're done with that, then we can talk about micro elasticity and how finance, cherished tenets of finance change, and time permitting, how you do macro finance with that perspective and maybe policy. Okay, so a few little facts. So first, who rebalances during equity downturns? Okay, what's going on? So here we have data from the flow of funds that divides investors into 14 or so categories, and like mutual funds, ETFs, firms, households. Now the household sector in part has a little bit of hedge funds or some hedge funds, so it's a bit of a hodgepodge. Anyway, so let's see during the first recent crisis, tech bubble collapse crisis, what happened? So the household sector sold. They were the big sellers, but by how much did they sell? Their quarterly flow was only 0.5% of the market. Okay, so even though they were the big sellers, in total it's a pretty small flow. 0.5% of the market, per quarter. Who was buying? It was the foreigners. The foreign sector was buying, and also the state and local pension funds. And we see it's not a coincidence, actually. There we go. So that was the first recent crisis. The second recent crisis was 2008 crisis. What happened? So similar story. So households sold a lot of equities. They were the biggest sellers, but by how much? By a very small flow. Again, like minus 0.5% of the total equity market per quarter. Okay. Also, interestingly, firms also sold a lot of equities. In part, they stopped doing share repurchases. Okay. And also, some of them were forced by the government to issue shares. So that's as if you were selling a negative amount of shares. So that kind of depressed the market. Okay? And who bought? Again, the state and local pension funds and the foreigners. Okay. Okay. And again, with small flows. Okay. So now let's make so we have small flows at big price movements. Again, it's consistent with prices reacting a lot to small flows, but let's have a model where we can think about that very cleanly. Okay, so I'm going to spend a few slides on very simple, very transparent two-period model. It will generalize very, very easily to an infinite horizon model. So here we take exogenous interest rate, exogenous risk premium. Okay, and they can be endogenized later in the full GE model, but that's a, that's a small detail for our purposes now. So there are just two assets. So things two-period economy, there are just two assets. There's one big stock, one big aggregate stock. Don't think about different little stocks. There's one big aggregate stock with QS shares outstanding, and that's exogenous and fixed. Okay, and there will be an endogenous price P for per share. And there's also a big aggregate bond in supply BS, like supply of bonds, with a price fixed at 1. So interest rates are normalized to 0%. Detail. Now, investors, they don't buy stocks and bonds directly. They buy them via funds. And there are two funds. There's a pure bond fund. It just holds bonds. Okay. And that's like your checking account, maybe. You hold bonds. And there's a balance fund. It will be the representative balance funds. And it holds some stocks and some bonds. And now it has a mandate. And that's really important. It has a mandate, which is the following. The fund has to follow the following rule. Say, if the fund has W dollars under management, okay? So imagine this eta equals 0 here, okay? If the fund has W dollar under management, it needs to have a fraction, invest them in θ% in stocks and 1 minus θ% in bonds, okay? And that's like a fixed rule. Now, a variant on that is, let's call pi the equity premium, and pi hat the deviation of equity premium from its average, pi bar, okay? So an embellishment is if the equity premium is higher than average, so if pi hat is strictly positive, then the fund is allowed to buy more equities that would be eta strictly positive. Eta could be 0, eta could be negative, okay? Okay, so there's this mandate by the fund, and we view that as either a reflection of institutional features, or maybe it could be even some rule of thumb in the representative investor's mind. I try to target a 50-50 allocation, or maybe depending on my age, it's a different allocation. Okay, so now this is a imperative mandate. Now, if the consumer was rational, the fund's mandate would not matter at all, okay? Because whatever the mandate, the consumer could always undo everything by adjusting its flows into the fund, okay? But the consumer will not be completely rational, and so the mandate will matter. Okay, so now we want to ask the following question. Suppose in our two-period model, the consumer wakes up at time 0 and decides to invest $1 in to sell $1 worth of the pure bond fund and invest this $1 in the mixed fund. What happens to equity prices? That's the question. Okay, so let's make it slightly more general. So we say at time 0 minus, before the shock, everything was in equilibrium, the fund was worth W0, and the equity premium was at pi bar, so everything is fine. Now, at the beginning of period 0, the consumer wakes up, and some consumer wakes up and decides to sell delta F dollars from a pure bond fund and invest those delta F dollars into the mixed fund. And give them to the mixed fund and say, invest that following your mandate. Okay, so that's a flow of little f %, and little f is the percentage, the dollar inflow divided the previous assets under management by the fund. Okay, so let's take some notations. We'll call little p the percentage change in the price, and little f the percentage inflow. Okay, okay, and so proposition. What's the action by the fund? So QD is the number of shares demanded by the fund, okay? And so the demand change by the fund is F, the inflow, minus zeta P. So where zeta is the all-important macro elasticity of demand. So first, F. So it makes sense that everything else equal, if I'm the fund, I receive an inflow of F %. Everything else equal, I want to increase my demand for stocks by F %. Now, the other part, the P here says, if the price of equities went up by P %, everything else equal, I want to sell some equities because they're a bit of a value, the equity premium has fallen. And by how much? By this zeta. Okay, and that's the macro elasticity of demand. This is if the price of equities goes up by P%, I want to sell equities by zeta P%. So that's a, price elasticity. And so here in this economy, it's going to be equal to 1 minus theta. Theta was my average allocation into stocks, plus eta. That's my sensitivity to the risk premium over there. And delta D is the average dividend price ratio in the economy. Okay. So, okay. So I won't give you the, so what's going on without going too much in the proof is the fund receives this inflow of delta F dollars, but its wealth under management increases by the delta F dollars directly, but also the delta F dollars make the price increase, which makes the value of the fund higher. And everything else equal, if the value of the fund is higher, the fund wants to buy more shares. So that creates a snowballing effect. And so the price will increase more than 1 for 1, so to speak. Okay. And when you work it out, it increases exactly. The demand of a fund will react to the price in that way. So one is the direct effect. Theta is the price went up, so I'm richer, so I want to buy more equities. That's why the elasticity is start with this 1 minus theta. Okay. So now we're ready to answer the question that motivated us, which is, again, the consumer woke up at the beginning of period 0 and decided to reallocate F% of its bond, delta F dollars of its bonds into the funds, which creates an inflow into the fund of F%. What happens to the equilibrium price of the equity market? So in equilibrium, the total amount of shares has not changed. The total amount of share supplies are not changed. But the total, but there was this demand by the fund. Okay, so the total shares, number of shares demanded by the fund has to be total change in that has to be exactly 0, because demand equals supply and the supply has not changed. So if F minus zeta P is equal to 0, it means P is F over zeta. So here we have a key basic result in this economy, which is if there's an inflow in the aggregate equities of F%, the price of equities goes up by F over zeta%, where zeta is this macro elasticity of the demand for equities. Okay, and in calibration estimation, we'll estimate the zeta to be around 0.1. That's the number I had mentioned, and maybe slightly higher. Let's say here 0.1. So it means that 1 over zeta is equal to 10. So again, this means that if there's an inflow of 1% in the market, the price of equities goes up by 10 percentage points. Another way to put the same thing is if I buy $1 worth of equities selling bonds today, the price of equities will go up by a very large $10. Okay, so the equity market is this kind of crazy at some level machine. You inject $1 in the machine, and boom, the machine increases in value by $10. And same thing if I sold $2, the market value of the market would fall by $20 in that economy. And anyway, so we found useful to go through this undergraduate example. So let's see very tangibly what's going on. So suppose we take simple numbers. So we have a balanced fund. Let's say it has a mandate of 90% should be in equities, 10% in bonds, and no sensitivity, excess sensitivity otherwise to the risk premium. Then its zeta should be 1 minus 0.9, should be 0.1. And let's say there's a supply of 90 shares in this economy, and there are B units of a bond. And the initial stock price is $1. So the balance fund holds all the stocks. So that's 90 shares of $1, $90 worth of stocks. And the balance fund needs to have this 9-to-1 ratio of equities to bond holdings in value. So it holds $10 worth of bonds. And the pure bond fund holds all the remaining bonds, so B minus $10 worth of bonds. Okay, that's the equilibrium at time 0 minus epsilon. Now, at time 0, an investor wakes up and decides to sell $1 worth of bonds from the pure bond fund and invest this $1 into the balance fund. So he gives the $1 to the balance fund. The balance fund needs to invest in the stock market according to its rule. So it's an inflow of 1%, given the balance fund had $100 under management and receives $1 extra. So what happens at the end of the equilibrium? So the pure bond fund $1 was removed from it. So now it has B minus $11. Where are those $11 in this economy? They're all in the mixed fund. Okay. And now the mixed fund, remember, it has by mandate a 9-to-1 allocation of equities to bonds in value. So the value of these equities must be $99. And at the same time, there are still only 190 shares in this economy. So, and they have to be held by this balance fund. So the price must be $1.1 per share. So what happened is there was a little 1%. So the stock price went from $1 to $1.1. So the stock price went down by 10%. So there was this little 1% inflow in the market, and boom, the value of equity went up by 10 percentage points. Okay. So in this way, we can see exactly where all the money all the assets really are. Okay. So now let's extend this to first, what if there's news about future dividends? So at time 0, there's news about the time 1 dividend. Then you have a slightly different demand. The demand reacts to, and the equivalent price, kind of interestingly, reacts to future dividends, which makes sense, but less than 1-for-1. So in this model, the price kind of overreacts to current flows, but underreacts to current news about future dividends. And again, that's because investors are because of their mandate, don't react very much to future things. Okay, so now let's look at an infinite horizon model. The charm is that everything I said will go through, but now it calibrates more transparently. So here we say, again, 2 funds, a pure bond fund and a mixed fund. The mixed fund has a mandate. If it has WT under management, a fraction theta on average is allocated to that. But if the equity premium is slightly higher than its average by pi hat bar, maybe it can hold more equities by by a factor eta there. There could also be some demand shock in UT that could relieve belief changes or changes in risk aversion or something like that. Okay, let's take notations. So I call P bar T. That's like the average price of equities if there was no disturbance linked to flows, news about dividends, etc. And little pt is the percentage change deviation of the price from its baseline value. And little ft, that's the cumulative inflow. We start from some baseline period 0, and then there's really some cumulative inflows, again in percentage terms. So once you do that, and again you look at the full market equilibrium where the mixed fund has to hold all the shares, you get that the little pt, that's the deviation of the price from its average, must be equal to the following: is the present value of the flows. So before it was the flows divided by zeta, and now is the present value of the flows divided by zeta, with some myopia factor, with some discount rate rho that depend on zeta over eta. So it typically, well, it's always strictly more myopic than in the traditional rational model. And a permanent inflow is going to create a price change of f over zeta. Okay, and very importantly, it's going to create a change in equity premium. So if I invest in the stock market, the price goes up and the risk premium falls, unlike in microstructure model where the risk premium remains constant, typically at 0%. Okay, so now let's, I need to follow time. What about if there's heterogeneous investors? With heterogeneous investors, you could say investor I has some elasticity zeta I and some forward-lookingness eta I. And then you want to look, when you do here microfinance, at the average elasticity, average demand, and then it aggregates linearly. And so then there will be an aggregate elasticity that's the size-weighted sum of average of all those individual elasticities. And the size, it's your share of equities, because if you're a bond holding only bond, you don't matter, okay? And so it's always equity weighted that you should do it. And for instance, this is the equity weighted share of mutual funds, very close to 80%, state and local pension funds, same thing. Okay, quickly, so frictionless model would predict a much higher zeta, okay? And here we have a little, suppose you have a very traditional IID economy with rational agents, and suppose the price of equities permanently is higher by P%, what will be, so investors, an individual investor will want to invest more in equities, but with what elasticity? There's a little formula here. When you calibrate it, it's with an elasticity of 20. So the empirical elasticity is something like 0.1. I will show you soon. I just claimed that. But traditional models predict a very, very, very high elasticity. Again, because investors are very rational and react to a very single move in the market. So traditional models are off by a factor of 20 times, 200 times. Okay. Okay, and maybe some inertia, some inattention would easily create this kind of low macro elasticity. The model calibrates well, provided if you say, look, typical investor has a share in equities of equity weighted of 90%, and a moderate amount of reaction to the future, you can easily calibrate an elasticity of 0.1. So it makes sense. And by the way, in the same economy, given the empirical flows we observe of about 1% a year, the volatility of returns just generated by flows will be about 10 percentage points. Okay, so you can explain a large fraction of the market fluctuations just via flows, and I'll show that more. Okay, so now let's do, if you have share buybacks, it's like an extra flow there. So now let's do an empirical analysis. So we want to estimate that zeta. We said potentially it's a very important parameter. So how do we do that? So we developed this granular instrumental variables technique that I'm going to explain to go exactly at that. And here are the data sources. Today, mostly the flow of funds, but there are other data sources. Okay, so I give you the spirit of granular IV. So granular, it kind of means there are some big idiosyncratic shocks by big segments of the market, big institutions, big hedge funds, and they're so big, and so the market is so concentrated that those idiosyncratic shocks materially affect prices, and we're going to take advantage of that. And so the spirit, before we go into the equations of GIV, is we look at, try to extract via factor model the idiosyncratic shocks to the various large players of the market, do their size-weighted sum of idiosyncratic shocks, and we're going to ask how do they affect aggregate prices, and that's how we're going to get our price multiplier, and how do they affect the demand of the other investors, and that's how we're going to affect to measure the demand elasticity. Okay, so now let me do that a little more leisurely. So we say, so a bit of notations. If you have n entities, like n in types of investors, we call SI their share of the equity, the share of the equity market they hold. The sum of the SIs is 1. And we call XS, that's the size weighted average of XI, and XC, the equal weighted average of XI. Okay, so let's say the demand for institution I, it's some elasticity zeta. Here, come on, later we can relax that. Some loading on eta is an aggregate factor, or maybe a vector of aggregate factors. And very importantly, it has some idiosyncratic shock. Okay, so in equilibrium, average total demand has to equal to 0. By the way, if you had corporations issuing shares, that would be one more sector issuing shares, demanding shares. That's the same. And so the price will be equal to the total demand shock. The price times zeta, the elasticity, will be equal to the total demand shock that has some size-weighted idiosyncratic shock. So let's take the case first, where all the loading on the common factor here is the same. Lambda I, same loading on common factor for investors. Then it seems like a good idea to form ZT, that will be our instrument. It's QST minus QET. So that's the QIT is the change in percentage space of the number of shares sector I holds, investor I holds, okay? And QST is the size-weighted change the number of shares held, and QET is the equal weighted change the number of shares held, okay? And so inside the logic of a model, here, if investors have the same common loadings on things, ZT, as it turns out, will be only made of idiosyncratic shocks. So really ZT will be the size-weighted idiosyncratic shocks in the demand for stocks minus the equal weighted. And the equal weighted is essentially 0, so we can even forget about it. So then for identification, given ZT, it's made of observables, okay? Namely the changes in number of shares you hold or percentage of the market you hold. But it's made of idiosyncratic shock, so it's uncorrelated with those aggregate shock eta. And as a result, it's going to be a valid instrument for things in the market, okay? And so more specifically, remember zeta p, it was in part the idiosyncratic shock, which is very, very close to Z. And anyway, so you can prove mathematically that if we do the following, you construct your zeta made of percentage size minus equal weighted percentage change in the holding of the various institutions in shares. If you regress P on the instrument ZT, the slope will be 1/100 zeta or price multiplier, okay, where zeta was this elasticity. That's with common loading. What if you have non-common loading to the factor model? You do basically, first you demean things, and then you run a factor model on the demean demand changes, and then you extract this way the factor eta t's, and you add those factors as controls in the regression. And again, as a theorem, if you run that OLS with the instrument ZT for the price, you're going to estimate the correct price multiplier 1/100 zeta. Okay, so we apply that idea slightly more refined because there are different types of sectors. The corporate sector, we do also we can do more parametrically. Anyway, for those of you who can look at that, let me show you what we find. So you find, so we also run a simulation. We simulate an economy and we make sure that even though our theorems tell us M should be well estimated, the multiplier M should be well estimated, 1/100 zeta, indeed we verify that via a calibrated stimulation. So, okay, so here's what you find. So again, here let's look first at the first line. So this is regressing the price on this instrument, and the instrument ZT is the size-weighted sum of idiosyncratic demand shocks. Okay, and so let's look at column 2, for instance. You find a price multiplier of about 7. Okay, so if I buy 1% of the market goes up by 7 percentage points in the same quarter. Okay, and this is here, and then we do various. This is number of principal components, 1 or 2, it doesn't really change. You win the horizon, not, it doesn't really change. It changes things a little bit, but not in any dramatic way. If you look at the elasticity, depending on where you go, it's between 10% and maybe 20%. Okay, what I was announcing. And so that's the key evidence, if you want, that we have for that price effect. Idiosyncratic shocks to large funds do have a big impact on the market with its multiplier of 5 to 10. You can do that at different horizons. You might say maybe it's very transitory. And so here what we do, we rate on ZT with some controls. The change, not only the initial change in the price, but the cumulative change in the price between the beginning of a quarter and to quarter plus each quarter later. And here's what you find. So on impact, we find a multiplier, again, roughly, 7, like I said. And then if that's on impact at horizon 0, but at horizon 1, 2, 3, 4, this is the cumulative impact on the market. There's zero evidence for mean reversion, okay? Again, consistent with the shocks I'm talking about, they're big. And also we know the market, doesn't really mean revert fast at small horizons. That's very little predictability at small horizons. And so those are really permanent, at least at the time scale of 1 year, price impact. It could well mean revert at the horizon of 20 years, but not at a 1 year horizon. Okay. And again, macro theory would be completely off. Say maybe it's multiplier should be 1/20, so completely off. Okay, so then let's say we have estimated the zeta. So how big are those impacts? So if we look at those demand shocks that we measure, and this is all quite preliminary, you need to clean it up, their volatility is something like 1.4% a year. And so here, the total volatility of a market generated by the demand shock, if you say the price multiplier is 10, it's about 40%. So really a very, very big fraction of the market can be explained or directly traced to those tangible demand shocks. And half of it is pure flows and half of it is more demand shocks that coming from expectations. Anyway, so once you see that, you predict that if we do D-mean flows, which is the green curve, and D-mean prices, removing trends, they should, really track each other. And here you totally see that. So in here, when flows have been high, prices are higher than average. When flows have been low, prices are lower than average. Okay. And now, if you just saw that, the causality is very unclear, but that's why we had this instrumental variable strategy, saying at least a huge fraction of that is really from flows to prices rather than the opposite. There could be an equilibrium with a feedback loop, but a huge fraction is from flows to prices. This is the same in scatter plot. And now, if you follow the same train of thought, and we're having fun exploring those things with Ralph, you would say, look, if flows become volatile in some quarter, returns should become more volatile. And here we plot volatility of flows and volatility of returns, and we see indeed they track each other. Here we're a bit silent about the correlation, the causation, but we want to explore that soon. Okay, so we have 7 more minutes. Let me just wrap up a few things. So one, you might say, what's the link with the big literature on the microelasticity of a market? Okay, so the that's like the index in the inclusion in the index literature. So here we work that a bit later in the paper. We say, look, suppose there are now lots of little stocks within the stock market, and stock A, you call PA the deviation of the price compared to some baseline, and that will be P the price and PA perpendicular. That's the how much higher than the rest of the market is stock A. And then you can have also a demand curve for individual stocks, and then you're going to get that if there's a little so if the price of stock A is off, suppose the market is just an equilibrium, the aggregate market, but the price of stock A is off equilibrium, here's how much the demand, there will be extra demand for the stock A. That will be with this zeta perpendicular. It has the very much similar shape as in the previous one. And then that clarifies that. So what is the zeta perpendicular? Is the macroelasticity of a market. So this is, if I want to buy a little bit of stock A, controlling for how much I want to buy of the aggregate market, here's how much stock A will increase. The price of stock A will increase by the flow into stock A divided by its microelasticity over there. And so that elasticity, its microelasticity zeta perpendicular, has been quite well estimated in the like stock inclusion literature. And you find typically an elasticity, a microelasticity of 1 to 10. Whereas here we're, I think, first one to show the macroelasticity, which is this 0.1. So it's a bit like Samuelson was saying, the market may be quite micro-efficient in the sense the cross-section of stock is fairly well, there's lots of elastic response to disturbances there, but it's much less macro-efficient in the sense that if the aggregate stock market is too high, well, you're a big fund, mutual fund, what do you do? Typically, you're stuck in stocks, and so you cannot sell the stock market. So that's why the aggregate stock market will be less efficient in the sense that it will be much less elastic. Okay, let me now revisit a few tenets of macrofinance. What changes in this inelastic world? A few cherished tenets change, somewhat interestingly. So one of them is prices are the discounted present value of expected future dividends, perhaps with also some rationally time-varying discount rates or changing in beliefs. So here you change that the deviation of the price is this present value of expected dividend changes plus the flows divided by zeta, this market inelasticities. Another thing is, share buybacks should not affect equity returns as proven by Modigliani Miller, where it's proven with assumptions that may not hold, okay? And so in the traditional model, the price impact of a share buyback is 0%, whereas here, at least in some short-term sense, if firms buy back $1 worth of equities, the aggregate market, the value of my firm may not change very much. The value of the equity market might go up by $10. Another, you say, oh, trading volume is very, very high, so equity market must be very elastic. No, because most trading volume, the 100% turnover in the market, it's all from stock to stock. I sell Apple, I buy Amazon, but not from stock to bonds. And so the actual stock to bonds flow are actually very small, maybe 1.5% a year. Another thing is often people say, oh, if you have a permanent price impact, at least at the 1 year horizon, it's permanent, it must reflect information. But no, in this model, and maybe in the real world, a one-time inflow into equities creates a permanent price change of the inflow divided by zeta, maybe times 10, with no information whatsoever. So anyway, this is kind of interesting for us to note. Now you might say, if markets are so inelastic, come on, the market seems very efficient, like there's very little predictability in the market. So if you remember, the price is discounted future value, future dividends and flows, is discounted at this rate rho over there, and rho is zeta over eta. So the price is the market is very forward-looking if rho is very small, which is here basically with zeta is very small. So you can have an inelastic market, low zeta, but very short-term predictably efficient. That would be if eta is big enough, eta is this sensitivity to the risk premium, then you can have a market that really smooth all the shocks and they're forward-looking in that sense. And last criticism, you would say fast and smart investors, maybe hedge fund will provide elasticity to the market. And I've said before, where they're small first, 5% of equities they hold, and also it's not clear that they're particularly, and also in downturns, where investors pull out, so they can't really do much. Okay. In 3-4 minutes, general equilibrium. So you can extend, and we do that in the paper, the whole thing to general equilibrium, and it works quite well. I just give you some of the ingredients. So we start by an arm economy. The whole tree, there's a tree, will be priced at an average discount dividend price ratio delta D. But there will be a divergence of the price from like fundamental price by this little PT that will be determined by flows, and the mutual funds follow our share. And so you need some behavioral element against, otherwise consumers will undo everything. And we say the consumer is rational in his consumption. The consumer, when he chooses bonds versus consumption, is rational. But he's twin the investor in the household, or partner perhaps in the household, that is behavioral and has some sort of narrow framing and random shocks to allocations into the mixed fund. When you work out everything, you find the following. You find that the economy will be described the following. So the Euler equation for the risk-free rate we still hold, so that's preserved. However, the price of equities will be exactly the one I mentioned before, but will be affected by flows. So the price of equity will be determined by these flows, which themselves determine on this behavioral shock to the mixed fund. And remember the SDF, our cherished or hated sometimes SDF. Here, you can say there's an SDF, but the SDF will depend on flows. So the SDF will summarize equity prices in a fair way. But the key thing is that in terms of causality, the flows will affect equity prices, and then ex post, so to speak, the SDF will reflect that. And then you can trace the impact on investment by firms, et cetera, and they're going to follow the SDF. And so the causality will be the shock in the mind of the investor affects equity prices because those flows change equity prices. And as a result, the SDF records that will change. And say if equity prices are higher, so the price of risk is lower, firms are going to invest more. So you can do the whole of traditional like macrofinance, but based on maybe more tangible flows. Okay, let me wrap up. Let me conclude now. So the theme today was markets are very inelastic. Okay, contra, well, the basic Lucas model, but all its successor, habit models, long-run risk model, disaster models, they all predict very, very high elasticity. Behavioral models also predict very high elasticity because investors in those models, they have maybe crazy beliefs, but they really believe their beliefs. So if they see the price is off their beliefs, they try to, they buy more a lot. And so the implications is now there's a horizon of doing macro finance on a much more tangible basis. So one of the criticism is that when you write some of those asset pricing models, they rely on traditional models, they rely a little bit on dark matters. There's some latent factor, maybe disaster risk or something that's supposed to change things. And with here, you replace that with very tangible flows, and you can trace of who was selling in the crash. So it was investors, but the foreigners, they buy, or the pension funds, they buy also. And so you can trace the time variation also in the market volatility to volatility in flows. And you can see really who was the moving market that quarter and why. You can trace that to their beliefs or their incentives or their constraint, perhaps in a very clear way. And talk about the source of market volatility. Now, like I said, once you have that, several questions that are just irrelevant or uninteresting in traditional models become very interesting. So maybe if the government buys $1 worth of about 1% of the equity market, maybe the equity market will go up by 10%, and that would be one way to do, quantitative easings, but for equities, and something like that has been done in Japan and China actually, and also when firms do buybacks and this kind of thing, it also would impact the market. Anyway, so we're pretty excited, Ralph and I, by all that. And there are extensions doing macro finance and also doing the bond market in the similar way. And maybe that would be a productive way to do all the regular macro finance we like, but based on primitives one can observe. Thank you very much.
All right, Xavier, thank you so much for a very interesting presentation. We're going to move into the Q&A session now, and so we'll call on people that have asked some questions, and you can also raise your hand in the raise hand feature if you would like. Let us start with
sorry.
Yes, please.
Can I just say, give you a few results from the impact, the survey we started at the beginning, okay?
Okay.
So we did two ways for that survey. So we did one web yesterday on Econ Twitter. This is my first tweet ever, anyway. And we said, oh, can you please answer this survey? And so let me reread the question so you're all on the same page. Question one was, if a fund buys $1 billion worth of equities, like permanently it sells bonds to finance that position, slowly over a quarter, how much does the aggregate market value of equities change? So there were roughly 200 responses. The median answer was 0, so like a very rational finance, okay? The median conditional on answering 0, strictly greater than 0 impact is 1 million. So that could be an elasticity, that would be a price multiplier of 10 to the minus 3, as opposed to 10. So it will be off by a factor of 1,000. Okay, so it means this crowd is off by a factor of, in this parameter, of 1,000. And the fraction answering above 1 billion is exactly 0% there. Okay. Now, our virtual finance was a separate survey with a separate URL. So that's what we started just today. So here I'm just discovering the results so the median was 0.75 million. So again, an extremely small price impact of less than 10 to the minus 3. Okay. But now the median conditional price impact would be a bit less than half a billion. So that would be a multiplier of 0.5. And that's a bigger fraction above 1 billion. So my conclusion, from that very informal survey, is that if you take the medium answer as some sort of conditional wisdom, people are off by a factor of, again, that's a price impact of 10 to the minus 3. People are off by a factor of basically 5,000. So so it's useful it's progress in finance if we rectify our priors by a factor of multiplicative factor of 5,000. Great.
Okay, very good. Thank you. Okay, let's take some questions. The first question we're going to take is from Laura Velkamp at Columbia.
Hi, can you hear me?
Yes, you're good.
Okay, great. Hi, Xavier. Enjoyed your presentation.
Thank
I
you.
wanted to know how is this different from Kyle's Lambda? So Kyle 89 is also an aggregate model. I understand the foundations of your model are quite different, and the way in which you're measuring this is quite different. But is the object, the Gabaix Koijen zeta, the same object as Kyle's Lambda?
Okay, great question. So it's completely different. So let me say. So in Kyle, if I buy 1% of a market, okay. So first in Kyle, if I buy 1% of the market will go up. But the key thing is that on average in this economy, the risk premium does not move at all. Okay, because it's all because of rational updating. Okay, and so on average, well, in this economy, like Kyle, the equity premium that on average never changes. When in this economy, if I buy, the prices will go up and the equity premium will fall. Okay, and the difference is that if I wanted to show, if I could say I'm completely uninformed, in Kyle that will have exactly zero impact, whereas in our world that will have a real impact.
Okay, very good. Next one is from Kenneth Ahern from USC.
Hi. So my question is about whether you're estimating the elasticity of supply or demand, because you're using equilibrium prices and outputs. So if you're looking at changes in demand, then
Yep.
you're actually identifying the slope and the elasticity of the supply curve. You know, as
Yep.
the demand moves up and down, you're tracing out the supply, not demand. So how should we think about that in your model?
Okay. So let me. So here, I like to go back to the two-period model. Okay. So in the two-period model, you had just this fixed supply. Okay. And so the same fund was receiving some inflows of F%. At the same time, this aggregate representative mixed fund had a demand elasticity of zeta. Now, if you had on top of that, and so that's how the price reacted to the inflow by F over zeta. But if firms were changing the supply of shares, it's exactly the same thing. There's an extra sector that will have a supply of shares. Actually, I even have a slide on that. So let me go back here. Yes. So you say the corporate sector could also have some supply of shares here. Okay. And then the aggregate impact, it's the demand shock divided the sum of the elasticity of a demand sector plus elasticity of a supply sector. And we measure, I didn't say it, but I should have, we measure, at least in the short term, the elasticity of the supply sector to be very close to zero. So it's basically, even if you add elasticity of how many shares firms demand or issue, that has almost no impact on that. But that's an interesting parameter too.
But I don't think it's a parameter. I think what I'm saying is that if you think about textbook supply and demand curves, if you want to estimate the elasticity of demand, you need to move the supply curve exogenously and hold the demand fixed. You're holding supply fixed and moving demand. So aren't you getting the elasticity of supply rather than demand?
Oh, great. Okay, so this is part of the trickery, the good trickery of the granular IV. So there are theorems in textbooks saying if you want to estimate the elasticity of demand, you need a supply shock. But the theorems are true, but under their assumptions. And here, they're not true because the world is different. Is if you have disaggregated demand, which is what we have, okay, demand by disaggregated holdings by sector 1, 2, 3, 4, 10, etc. Then you can estimate the elasticity of demand via only demand shocks. And basically, you look at the big demand shock from sector 1 and 2, and you see how they affect the demand of sector 3, 4, and 5 in spirit. Okay, and that's how, with only demand shock, can still estimate the elasticity of demand. And that's the whole point of this granular instrumental variables. So that's why we think that it's a useful tool for lots of things in macrofinance, where I like to say, oh, if there's more demand for the Turkish lira, what happens to the Turkish lira? Likewise, you would look at hedge funds and how idiosyncratic demand for the Turkish lira and use that as a primitive shock to the price, and then maybe look at the impact on Turkish investments or wages or whatnot. Yeah. Thank you.
Okay, thanks.
Great. Next up, we want to take a question from David Schreindorfer from Arizona State University.
Yep, can you hear me?
Yep.
So I think like many, I was very surprised about the magnitudes, and I was just wondering, why can I not exploit this by trading in option markets? So basically, I was thinking like buy a call option, buy a dollar off the market, make it go up $10, exercise the option.
Well, because so if you were absolutely enormous, well, like in all of classical economics, if you were absolutely enormous, you could do a certain amount of market manipulation. But if you're relatively small, it's going to be very, very, very hard to. So even if you have like a $10 billion under management, still as you trade, the aggregate market will increase, but you'll still hold a very, very, very small fraction of the market, so you won't benefit in any big way. So investors are, pretty close to the infinitesimal investors in practice. So it's very hard of them to manipulate the market in a big way in this economy. But the governments and all that could do that, and like the Hong Kong did that when they were under attack in the, I think, mid-90s or something like that. They bought the Hong Kong stock market really to fend off the Soros of the world, and that worked. Yeah.
Thank you.
Great. Next up, we have Francois Gouriot from the Chicago Fed.
Bonjour, François. I don't know. Oh, I can't hear anything.
Francois apparently just left you, unfortunately.
Okay.
You'd have to catch him on the French grapevine.
Okay.
Let's go to Chris Lamoureux at the University of Arizona.
I have a couple of questions. The first had to do, I think, what's probably the most obvious, which is short selling. I inferred, I guess, from your observation that hedge funds are very small, that precludes any sort of large-scale short selling with respect to the magnitudes that you're talking about. But nevertheless, as a traditional kind of neoclassical finance guy, I do think of those supply curves as being perfectly elastic.
But you should not. It's nice to think about it, but that's not the world we're in. So, I mean, you said you had a couple of questions. So here, no.
Well, but short selling.
So what about short selling? So here, at least in the model I showed, short selling is totally allowed. There's no limitation to that. Now, people don't want. Either it's the mandate or it's a self-imposed mandate. They don't want to react too much to the price. It's like here, the stock market fell by 20%. You should react enormously to that if you are a very rational trader. Maybe you, for a number of reasons, you don't.
Okay, and then my second question.
Maybe in part is you can't short sell your human capital. There are things of that nature that prevent. Maybe not super rationally, but de facto make you not want to do it. Or maybe it's completely rational, but it's a much richer rational model than the plain traditional model. Yeah.
So my second question then is perhaps just a question of semantics, but I did want to get your take on it. Mm-hmm. And that is, I think of an idiosyncratic shock as a shock that can be diversified away in the aggregate. That is, it will have no effect on the pricing kernel or on aggregate supply and demand. But here that doesn't seem to be the case. So is that purely a semantic question, or is it a intertemporal problem of what is idiosyncratic?
So it's largely semantic, okay? So imagine you have, that's what we do when we use the 13F data, which is all the movements of large funds above $50 million, so not that even large. Then you have, say, thousands of funds. And what you do, just in terms of the underlying model, they all react to a vector of common shocks, a movement by the Fed and whatnot. And also they have some extra, it's more, I have an extra, it's a decision by myself that's not explained by everything else in the market. So it could be a random belief shocks, or have some idiosyncratic views, or it's a random bet or something like that. So that's what I mean by idiosyncratic. And given some of those funds, they're not that small compared to the market, and the market is very reactive, they're going to have a material impact on the market. Yeah. But the mathematical definition, it's not small, it means it's orthogonal to the aggregate shocks. That's the uncorrelated to the aggregate shocks. That would be the rigorous definition of idiosyncratic here.
But that doesn't hold intertemporally then, right? Because then it does affect the aggregate next period. Or
no, that's right. So it will affect the aggregates as well. So in the same period, remain in the one period economy or two period model. Okay. So within period 0, there's the idiosyncratic shock. Take my little consumer in the 2 period model at the beginning. This consumer has an idiosyncratic desire to transfer $1 from his pure bond fund into a mixed equity fund. Okay. Transfers this dollar bond. Okay, that's idiosyncratic. That's uncorrelated to any big macro event. It's going to have a real impact on the aggregate price. So idiosyncratic shocks have an impact in the sense of orthogonal to aggregate to common factors. Will have an aggregate price. I agree that here we reach a bit the limitation of language, but hopefully the math is very unclear. There's a common macro shock or vector of macro shock eta, and there's some little domain shock UITs that are uncorrelated with that.
D'accord.
I hope that helps. Yeah.
Okay, great. Thanks, guys. Next up, we have Andrea Eisfeld from UCLA.
Okay, thank
Andrea.
you. Hi, guys. I really enjoyed that, and I'm very, I'm very open to the idea that there are sort of like market technicals and price impact and those kinds of things, especially in more complex assets. The other thing I was going to mention is I know the big banks. So when they talk about big data, a lot of what they're collecting is their own data on flows, especially the broker dealers. So I think people pay a lot of attention to that. Along those lines, I was thinking, shouldn't they be using the information about where the flows are coming from? So if it's really households selling, wouldn't we think of that differently than if it was, I know hedge funds and households are in the same category in flow funds, but, maybe sort that out with the 13Fs, treat those two categories differently. So I guess I have 2 questions. So if there's time, Lars, you'll tell me, you can cut me off.
Go ahead.
So the short answer, let me take the first one. Yes, sure, there's a business idea there, which we were not in the, we don't want to pursue, which is if you have disaggregated data on the flow and you can run the flow and maybe they have slightly different speed of mean reversions, you can, a priori, you can make a little bit of money. But I want to caveat that a little bit because in this economy, the intertemporal price, the price is very well arbitraged intertemporally, not exactly, but 99% well. But if you could know the flows, an hour in advance, you could make a lot of money. And that's what a lot of the front-running industry working of the, order flow tries to do.
Yeah, and I guess I was just thinking they would make different inferences about that deviation of the equity premium from its mean value or something like that, depending on, their inferences about the flows, drivers of the flows. So then the other comment that I had is just something that, has been in the back of my mind as I've thought about slow moving capital and the way markets are organized, which is, thinking about it from the corporate finance side of things, these models of dynamic capital budgeting where, I'm like one of N division managers. I'm always going to tell the upper manager that my project is the best because maybe I get paid as a function of how big my division is. And the division, the big head honcho is going to give me, allocate me more money the more, I advocate for my own investment opportunities. But if I start to ask for funds above a certain threshold, then it goes through some bigger decision process. And I think the way a lot of assets are managed, you have these single asset class funds, and then you have a lot of multi-asset class funds. When you try to move assets across, move funds across asset classes, there are a lot of these institutional kind of contracting frictions involved. And so I guess, one thing I was wondering as I was listening to your talk, and it's something I should, think through myself, is how would that kind of micro foundation, make some of these predictions more precise?
That's very interesting. So we don't pursue that because the paper now is like a, borderline too big. But that would be very interesting to understand a little better, if you want, what's the demand, what's the origin for. Here we have some sort of, this thing here was some sort of stylization of the average demand in the market. So why is it, in particular, this eta? It means, even if stocks are much more favorable, have higher expected return than bonds going forward, why is it that you don't see more money flowing into stocks? It's like the slow moving capital. In part, it could be some principal agent frictions, like the head of the equity desk says, yeah, equities are great, but the CEO doesn't really know, or and investors don't really know. And it would be interesting to look at the macro foundation, of that. Yeah. And maybe one could make this way more refined predictions about, flows between stocks and bonds, or different kinds of stocks or different kinds of bonds, and that would be helpful in that on that road. Yeah, absolutely.
Yeah, thanks a lot.
Thank you.
Great. We wanted to take a question from a PhD student as well. We have Oliver Giesecke from Columbia University.
Oh, hi. Can you hear me?
Yes, we can.
Yes.
Very good. So on a conceptual level, I was wondering, if you think about the literature on index additions, so some of those papers used like the cutoff between the Russell 1000 and the Russell 2000, and so the Russell 1000, at least according to Wikipedia, accounts for roughly 90% of market cap. So that seems to capture the equity market relatively well. So how do you think about the differences in the elasticity?
Oh, so that's what we're calling, but I went really too fast. That's what I was calling the micro elasticity of a market, which is this whole literature on index exclusion is, there's less demand for the stock that just was deleted from the index and more demand for the stock that just got included in the index. The total demand for equities as a whole is exactly the same. But the nature of stock A has less demand and stock B has more demand. And so they measure that. And so in terms of the model I sketched too quickly, okay, here's the price impact of stock A, given the aggregate demand for equities has remained the same, but there's more demand for stock A and less demand for stock B. And that elasticity, that micro elasticity, if you want, is much bigger, probably by a factor of 10 or 20.
All right. It's just about 10:45, so I think we should call it a day. Thanks to everybody for attending, and thank you, Xavier, for a great presentation. We wanted to just say that next week, same time, we're going to have Annette Wissing-Jorgensen from Haas School of Business at Berkeley presenting. Okay, so thank you all, and we'll see you again next week.
Great. Thank you, Lars.
Thank you, Xavier.